Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Mark Helm. Mark is the co-founder of Self-Storage, a self-storage and construction company. He is the author of Creating Wealth Through Self-Storage and the creator of Storage World Analyzer. And today we are going to be talking self-storage development, and boat and RV projects as well. So Mark, welcome to The Wealth Flow.
Hey, Keith. Thank you. It's a real honor to be here.
Yeah, I'm looking forward to today's episode, and I typically will start, Mark, with really your background, where you grew up and what eventually led you to investing in self-storage.
You got it. Well, again, thanks for the opportunity to be here. I wake up many mornings, and I woke up for most of my life as a commercial real estate agent. And I got my real estate license May 1, 1985. Haven't had a W-2 since then. I know a significant portion of your listening audience is W-2 income, but my journey started as a real estate broker. And it took me, I ended up getting my CCIM designation in 1995. Now, CCIM is like a it's not like a PhD, but it's like a master's degree in commercial real estate. And a lot of the institutional players in the commercial real estate space won't work with any agents unless they're CCIM. So I went on and got that designation. And at the time in the mid-90s, I had developed myself as an office specialist. I had put together, I didn't do the deals, but I had a group of buyers, different buyers who would buy office buildings. I'd help design a plan to reposition those office buildings. I would manage them. I would lease them up for them. So I was heavy in the office business. And I got my CCIM designation, and I'll tell you, within 2 weeks of that, I got this phone call from a then REIT in the self-storage space. And they asked me, and I'm sitting in my office in Louisville, Kentucky, and they said, can you help us find self-storage opportunities in Kentucky? And if you call an agent, ask them to help you find property, there's usually only one answer. That answer is yes. So at the time, here I'm this agent. I was making good money, but I spent a lot of money. My lifestyle basically took what I was earning. And I'm a guy in a coat and tie driving around using fancy Argus analysis software that REITs use to analyze office. And so I meet this acquisition director of this REIT, and he's in jeans and a T-shirt, and we go out and start looking at self-storage. And I thought self-storage was a simple little business for simple little people in the mid-90s. And didn't take me long to really get what self-storage was. I'd worked for a developer earlier than in the 80s, and he had built a lot of flex space, which is basically a steel building and a concrete floor. There is some office in flex, but in many ways, flex was a lot like storage, because at the time in Louisville, anyway, that warehouse portion, concrete floor, steel wall, was getting about $3.50 a square foot. The same building, in essence, was getting, at that time in Louisville, $9.50 a square foot for non-climate, $12 a square foot for climate control. I saw that these guys could project their cash flows very accurately. Because there's no commission, no tenant improvements. Well, I fell in love with it like real quickly once I really got what it was. And I thought, how can a guy like me get in that business? And I had one skill set at the time, and it was finding deals. So I found deals. I didn't have the cash to do the deals. I didn't even have the wherewithal to sign on a loan. So I got partners that signed on loans with me, and I syndicated my first deal and have been going ever since. I closed my first opportunity December 31, 1999, and have been going and evolving ever since then.
Okay. No, that's that's interesting. You bring up a couple things there, and maybe for the audience, when you talk about predictable cash flow and not having to pay commissions, you were used to going from an office space. Can you maybe explain kind of how that would maybe disrupt some of the cash flows or anticipated cash flows when you're working with agents that are finding tenants for you on the office space side?
Oh yeah, it's great comparison, and I loved being in the office business because I was making fees. I would make renewal fees, but as you know, all commercial real estate assets, you got income, usually rent. You have operating expenses, then you have your net operating income. And the value of your asset is a function of what a ready, willing, and buyer pays for that NOI. Now, below the NOI, you have your loan payments and your capital expenses. Now, when in the office business, if you're in most real estate as a manager, most commercial real estate, you're really in the tenant renewal business. That's the business you're at. We measured a lot of our success by how much we got that NOI going up and how many of the tenants would renew their lease. We were in the upper 80s. So we would have growing NOIs, good renewal rates, but it was absolutely nothing for net cash flow. The owner to pony up at the end, by the end of the year, he's had negative net cash flow distributions because he's had to pay for commissions, which is not an operating expense. He's had to pay for tenant improvements. And back then, we had mostly B-class office buildings in downtown. We would budget back then $5 a square foot to renew a lease because often we would have to paint, we would have to carpet, we got a renewal fee. And if the tenants moved out, you would have tenant improvements. It was nothing to have a dumpster and a chute come out a window, and tenant improvements that had been put in 5-10 years ago slide down that chute, and you'd have to reconfigure the space to keep that cash flow going. Back then, it was like we averaged $20 a foot on new leases. So it was nothing to have great NOIs, good value, but the owner had to pay money. The very few I learned real quickly, because my entry point into self-storage was seeing how REITs think, and it's pretty much the same. Back then, they had like a 12 cent. Today, I'm using like 15 or 16 cent per square foot reserve fund. And that covers, in almost all cases, any capital improvements that would come up. So we start a reserve fund, and each year we put in about 15 cents a square foot per year. We had a $60,000 sign blow down one time. Insurance, when we carry $10,000 insurance deductibles. So $10,000 came out of that reserve fund, the balance from the insurance company, and our investors that month, that $60,000 sign went up. They didn't lose 1 cent in distributable cash flow. The capital improvements are very predictable, and you know when they're going to happen. I know the life of an HVAC. I know if we're asphalt, how often we got to asphalt it. No commissions, no tenant improvements, very few capital expenses. So other than your loan payment and your reserve fund, in most cases, NOI less loan payment, reserve fund, that's distributable cash.
Yeah, that sounds like a huge advantage. And obviously you recognize that pretty well right away. As you were involved in your first one, you said December 31st, so just got it right in at the very end of the year, huh?
Yeah, that's right. We were able, back then, the seller had some tax loss carry forward, so he was motivated to close that year, and so that's when we closed. And then quickly I put together 3 deals, and then we got an unsolicited offer from a private REIT at that time, and the way I was organized, majority ruled, and we sold them. And I was out in about 2003 as quick as I got in. And investors did great. I did okay. And I went on with life. And then I moved back in, believe it or not, February 2008. I don't know if you remember 2008.
Yeah,
But
I do.
I put a property under contract in 2007, and then all heck started breaking loose in the economy. And that's another story in itself, but we ended up closing in February 2008. And thank goodness I had a storage facility, because even though we'd lost maybe 8% of our occupancy at that point, it was 18 months before I made a real estate commission. I went 18 months with 0 commissions in 2008, but I had storage, so I had cash flow.
Yep, I remember those days as well. I was a full-time real estate broker, more on the residential side, but during that same time frame, and I think we closed stuff, but it was not anywhere near what it was prior to that, and so yeah.
Well, commercial funding froze. I remember we had that property under contract, and we were putting a CMBS loan on it, and I got a call from the broker, I don't know, November, December, and I'd heard something I had no context for. It was, your funding on Wall Street has evaporated.
Oh, wow.
I said, what do you mean? He said, there are no CMBS loans being funded anywhere in the country.
Wow.
So just totally blew up, disappeared, but we ended up closing.
So did you end up finding a different loan on it, or did the seller carry?
Yes.
Or what,
yes. What I did was, of course, I had, at that point, I syndicate deals. I've never run a fund, but I've syndicated, I think, every deal I've been in just about. And of course, my investors went away. So they were scared, and, Lehman Brothers is folding, the loan had gone away, So I had 2 weeks till the end of my due diligence period. Well, I went to, part of my real estate life, I went to a real estate exchange group, and I saw a empty industrial building at $1.2 million with no loan on it being, presented up from the podium. And I needed $1 million to close on this deal. And I asked who the owner of that building was, and it was somebody I knew. I'd listed and sold some of his real estate earlier. So I said, I'm a taker for that building. Of course, I don't have any money at that, but what I did was I ran over to that person's office, laid down my pro forma, and I said, exchange your building into this deal. I'll give you 70%. He ended up getting 80, but I said, I'll give you 70% of this deal, and you give me your building, and I'm going to refinance your building, put an 80% loan on it, which I could do at the time. And that was my down payment into the deal. And then he held a second for 20% on that building. And he helped me get a loan with a local bank to do that. And that's how we closed on that deal in 45 days.
Wow. That's incredible. Yeah. Very
That was
creative.
That was a fun deal. No matter what happened, and there was other stories to it too, but no matter what happened, I closed that deal. And whether the deal did great or not, you'll never take that away from me, because I was able to close that deal when there was no, CMBS loans going on, and many banks were scared.
Yeah, for sure.
So that's fun.
Awesome. So, as far as self-storage, you said that during that time frame, that rents and occupancy, did you say went down about 8% during that time?
What's interesting is rates. We're getting in kind of the nuances of the actual business. Storage it's a real estate play, but it's also an operating business. It's like building a shopping center and then opening the store in the center. In 2008, my rents really didn't go down. I didn't reduce my rates, but my occupancy went down a little bit, went down 8%. But compared to office, compared to retail, even apartments at the time, storage did real well in the recession, which caused its own challenges later on. But storage did real well. But my occupancy went down 8%, and I did have to burn more calories in collections, staying on top of collections. But overall, 8% in 2008, when you go from 92%, down to whatever, it's not that bad compared to other asset classes. And learned a lot there. Nothing is recession proof, but if there is a recession resistant asset class, it's storage. Because if you think about it, the customer in self-storage is, for the most part, people who are in some type of transition in their life. We have about 20% commercial on average, but people who are moving, people whose parents have died, people who are getting divorced, something's going on, they need more room, and boom times create those type of changes, and down times create those type of changes. In COVID, other than the first 2 months when everything was shut down, during COVID, our occupancy went up. COVID created demand for self-storage. Didn't create demand for office. Didn't create demand for flex space. Created demand for storage.
And so tell me a little bit more about how your engagement within in self-storage. You bought this other property maybe 5 years after the initial one, if my timeline is correct. Mm-hmm. And then after that, what did you do from there? Were you still buying existing storage units? And then I guess where I'm going with this, Mark, is what eventually led you to starting to kind of develop these from the ground up?
Good. Well, my goal was to own a portfolio of self-storage, and my goal was to do it with investors, and provide benefits to investors, but allow me to own, control, and run a portfolio of self-storage. So I became a syndicator by default. And so what I would do is find deals, like I did the first few, put them under contract, go out and raise the capital, do all the due diligence. I never have, like I said, run a fund before where people are putting in a blind pool necessarily, but I'm a syndicator. So that's how I got going on it. Now, I didn't realize it at the time, but how I syndicated apparently is what I don't do it this way anymore. But when I was first getting going, it was today people think it's a hard way to syndicate. What I did was I would, each storage project had its own LLC, and me as a sponsor or my small group as a sponsor, we would own 70% of the LLC shares. Now, what we would tell the investors is that you would get, while your money's in our deals, you own 30% of the LLC, but while your money's in our deals, you're going to get 90% at least. Usually I paid 100% of the distributable cash flow till you get all your money back, or and if there's any unpaid preferred return, you get all that back. Then once you get your preferred return and all your money back, then we call it a conversion. Then something happens, and then you're still in the deal, no money in the deal, but you get 30% of the ongoing cash flow, and you'll get 30% of the upside. So if I was raising money, I call it country club money. I was raising money from people we knew, acquaintances, friends of friends, etc. And they felt safe because we weren't getting any of the cash flow until they got all their money back and their preferred return. So they knew we were really incentivized to make that happen as quick as possible. I did get management fees. And I did get, if we did construction, I called it a developer's fee, but I made a little bit of money on the development side. Our business model was, we looked initially, and then it expanded. We looked initially for like mom and pop facilities, which back then 80% were. Today, still 60% of all self-storage facilities are owned by people who just own one. Mom and pop facilities. Even though REITs have made a huge inroad in our space, there's still a lot of consolidation going on. But we would look for mom and pop facilities. 25,000 square feet, and then we would add another 25,000 square feet. We would always create an asset that a REIT would at least look at. And I knew what REITs wanted. So we tried to take mom and pop facilities, enlarge them, and create what we call institutional grade assets, so that on our exit strategy, and whether you buy and hold forever or you're buying to improve and sell, always start with an exit strategy. So our exit strategy was institutional buyers, and that was our bread and butter. And then we also did conversions, which is buying empty existing buildings and repurposing them for self-storage. Really, I probably made more profit per deal on that than anything I've done. And then soon we started doing a few ground up projects, developments. I never built a multi-story, 100,000 square foot, 100% climate control like you see a lot of the REITs do. Now, every cycle, every time since I first been around self-storage, which was 1995 as a broker, but even when I first closed, every time period has its own challenges. Today, the challenges and I consider myself a smaller, some of the guests you've had on here are just, run funds and done extremely well in life. I walked the other side of the street. I decided not to be in the fund business. I'm more in the storage business. And so I syndicate deal by deal. And most of the time, investors can say yes or no to that deal. There's pros and cons either way. But that's just the side of the road I walk on. And, back in 2008, the challenges were financing. Not every bank loaned on it. SBA didn't start loaning on storage till 2010. Today, the challenges are in many ways a direct result of how well self-storage did during the recession. During the recession, there were like three shining stars in the commercial investment real estate arena. One was medical office did real well. Two was student housing did real well back then. And three was self-storage. Now, if you think about 2010, 2012, medical office, how much? $300 a square foot, maybe $250. Student housing is like resorts. That could be $400 a foot. Back then, institutional grade self-storage, we were expanding and building at $50 a foot.
Wow. Yeah.
Another reason I liked self-storage. But as it did so well, a lot of funds were created. A lot of money started flowing into self-storage space. Most people you talk to say, I see them everywhere. Well, that's because a lot of money started flowing in after the 2008 recession. And funds were created, and you see these big projects built. Cap rates went down, prices went up. So today, the challenge is just finding opportunities in trade areas, not even cities, just trade areas where it's not overbuilt, and there's ways to do it. And, the fact that it's still expensive to buy. And when you put on the interest rates as well as how construction costs went up, those are the challenges today. 1995 challenges were different, but you had challenges.
From a construction standpoint today, what are you seeing on a price per foot?
Well, that's an interesting question. So in our model, let's say from 2010 or 10, 12 through 2020, we're not building huge mammoth, multi-story projects. We're doing 1 or 2 story expansions, or I'm buying a building and erecting a storage system inside the building. I didn't realize that I was creating a process, but I never used a general contractor to build. I would always, I would lean on the fabricators, the companies that manufacture the storage systems. They provided me a lot of services. I did that because I didn't have a lot of money to spend during the design phase of it. So I would lean on these fabricators for plans and a lot of services they offered that are included in the price of the unit. And I would keep my engineers and particularly the architects on a tight leash. And basically they would respond to stuff I would present them from the fabricators. And I would hire them, hire the erectors, get the plumber, get the fencing company. And basically, I didn't realize it, but I was functioning like a GC. I was just trying to save money. So 2000, and we were building at $50 a square foot. Yeah, you can build cheaper, but we were doing nice product, wrought iron fence along the front, gate entry, cameras, lights, the whole 9 yards. And we were building about $50 a foot. For whatever reasons, starting around 2020, most of the lenders that we've used require now a GC. Okay, so the pandemic's over. We're doing expansions and conversions. I got to use a GC. So I send out a layout to the GCs. I was shocked. $95, $130 a square foot. We were getting ranges from $95 to $130 to build what I was building a couple years ago at $50 a square foot. And part of it is construction costs have gone up. But the other part is, heavy reliance on the engineers and architects to do design build kind of layout type stuff. So I did what most entrepreneurs do when they've got a challenge. You start a company to solve your problem. And I'm not a GC, but I've had a lot of experience in building self-storage. So I partnered with a person who has a lot of GC experience that was really excited about niching down in the storage space. And I shared my process, and then he took it and really modified it and made it better. And we're building now at $75, depends on the location, but $75 a square foot. So we're still 25 to 35 a foot higher, but we use an improved version of what I used to do. We have national architects on an hourly basis when we need them. And we usually get a local engineer with storage experience that reacts to what, doesn't create, will react to what we give them and then help lead the charge through the approval process. So that's kind of my world of construction right now. Started with my own projects, and we're also doing, third-party construction for people kind of in my network. I coach, teach, in the introduction we talked about, I have an online service. I do some consulting, and I help small investors get into storage space. And in my little kind of world, some of them are using our services too.
Yeah, no, that's interesting. And yeah, sure. Starting a company based on kind of the necessity that you had after 2020, just seeing how much of a difference. And that's a huge savings. I mean, if you look at, you gave a range there, but when you look at $130 a foot and you're able to dial that back down to 75, it gives you a huge advantage.
Pencil out that would otherwise not pencil out. The process takes a little longer, and it isn't for everything. Like if we were doing a 5-story, 120,000 square foot, this process doesn't work for that. If I was doing a shopping center, we would start with the architect and the engineer. If I'm doing an office, a hotel, this process works for storage. And smaller, what I consider smaller, like 70,000 square feet, 1 story or less. Sometimes we can get fabricated 2-story and 3-story buildings, but for the most part, most of what we build is either inside a building or single story, and this process works for that. It's a little bit longer, but it sure saves a lot of money, particularly in the design, development, approval process, and in the building plans.
Tell me a little bit, Mark, about kind of when you're looking at a project, are you doing any kind of climate control? And if so, what portion of the project, what seems to be a good fit? I'm sure it's market specific in some areas, but just curious in general as to what seems to really work right now in self-storage.
Well, I'm lucky at self-storage because self-storage is very localized. So, in other words, what's going on, you're in San Antonio right now? Yeah, sitting in San Antonio. So what's going on in self-storage in San Antonio is interesting, somewhat relevant. If San Antonio is overbuilt, there would be some downward pressures on maybe the rents. But for the most part, that's irrelevant. What's very relevant is what's going on in your trade area. In our portfolios, 86 point something % of our customers live 3.2 miles from our facilities. So in most cases, I can send a drone up in the air and see my customer base. So what's going on in your trade area is critical. Now, not every facility has a 3.2 mile trade area. Some are drive time. If it's more rural or not in, if you're out of the San Antonio, but maybe even still in the San Antonio MSA, but it's more rural, you'll have maybe 5-6 mile. But whatever's in your trade area, that's what's extremely relevant. And today there's subscription services we can log on to. So I would log on, any address, almost any address in the country. I can look and see what's going on in that trade area. I can see what rents are. I can see how much discounting's going on. I can see how many square feet there are. One of the main measurements in our industry is what we call square foot per capita, how many square feet of storage per person there are. Texas, for some reason, has more square feet per person than any state in the country. But, let's just say 9 is equilibrium in San Antonio. Then I can look and see in this trade area what's current, what's in the pipeline. Now, not everything in the pipeline becomes square footage. Some of them die out, but I can make an educated guess as to how well that trade area is doing. Then I look at how much climate control is in that trade area. I can see in some markets that I might be at 6 square or 8 square feet per capita for non-climate, 3 square feet for climate. That tells me if I'm going to add more square footage, I probably need to get, it ought to be climate control. When we do conversions, those buildings are almost all climate control. There may be some exterior units, or if I have excess land, we'll build some non-climate outside. But usually inside a building, it's almost all climate control. If you looked at if you took all the facilities in the country and measured how many are non-climate and how many are climate, it would probably today be around 35% climate, the balance non-climate. In the old days, when I first started working with the REITs, on average, it was about 30% climate, the balance non-climate. And then it's also a little bit market specific. There's some markets like Columbus, Ohio, for example. I don't know why, but there it's about 15% climate control demand. Now, the good thing about storage is because it's such a localized asset class, 3 miles, 5 miles, that's your market area in most cases. We also, during the due diligence, get an independent third-party feasibility report those people will really dive into details, and they will give us what they suggest as the mix of climate, non-climate. They'll even have suggested rental rates. They'll tell us, based on the history in this trade area, what they anticipate absorption, or in other words, how fast new space will lease up. And they tend to be incredibly accurate because your trade area is so limited.
Yeah, that's pretty neat. That's a great third-party tool to be able to use. Just well worth the money, I guess, especially if it is accurate.
I would not bring. Now, not everybody does it, but I have investors usually in many banks. If they know what they're doing, will require it. But I wouldn't bring a square foot on without a feasibility report. And the ones that say don't do it, we don't think that there's demand for more square footage in this area. With our subscription services, those are less and less now because we know ahead of time whether we think it's overbuilt. But those are the best ones because they stop me from going out and doing a deal. In my experience is investors appreciate the acquisition discipline to walk away from a deal if we don't think we're going to be able to get close to our target numbers.
Yeah, for sure. Well, let's talk maybe a little bit about the existing buildings and building a storage unit within there. I'm curious on, is that a building that you own, or is it a area that you're leased, or is it a combination of that? I just when I think of leasing a space, obviously, if you look at any kind of retail, there's a lot of these vacant spaces that seem like they'd be great for that. It just, I guess my concern from an outside, not knowing, near enough about self-storage just would be to, go through, make that investment within a space that maybe you don't own, and then the rates and the lease amount goes up on that building.
Well, we would never make that investment in something we don't own.
Okay.
And if you did, the numbers probably wouldn't work well because your loan's going to probably be a 7-year amortization. But you'd be surprised how many retail opportunities there are where you can buy, part of a shopping center, a big box part of a shopping center. You could go on LootNet right now, and there will be a ton of those listings. Retail, those do very well. Where I've had more, what I really love is, now you've got to be in a good location. So for self-storage, it's a retail. I relate to it like a retail business. We're talking about sales. We're talking about retail sales per move-in with our managers. We basically have 5 key performance indicators and running it, and sales is involved. Our managers, we train on sales techniques, how to answer the phone, etc. I relate to it like a retail business, even though it's a real estate play. And so I want to be in retail type locations, which sometimes is a little challenging because when you're getting $12 to $20 a square foot and Walgreens might be getting $200 a square foot in sales, it's kind of a different animal. But I want visibility for storage. Different for a boat and RV, but for storage, I want visibility. So that's the primary thing I'm looking for, is buildings that have visibility. At any given moment, only 10% of my population's going to maybe need storage. But theoretically, I want 100% of my trade area seeing me. That's my goal. And then they think of me, or when they go on Google, they see us and go, oh yeah, that place. So I look for buildings that have good visibility. And so the first conversion I ever did was in 2010. Theoretically, the recession was over, but it sure didn't feel like it, at least here. So I was really concerned. But I had a partner really pushing me to do a storage deal. So I found on Main Street, kind of right off our CBD. That area became really gentrified about 2015. So I looked like I knew what I was doing. I was lucky. Or I'll put it another way, it's grace of the universe. But we bought this I think it was 42,000 square foot. In essence, it was like a warehouse, but it was on Main Street, and it had been a lumber yard. So it was an urban lumber center from a local lumber company. They also had one out in the suburbs, and during the recession, they decided to sell this and move everything out there. So what I loved about it was the ceiling height in the majority of the building was over 17 feet. So I could buy square foot building and put 2 stories. So I could pay for square feet and get income on cubic feet. So I was also working with a friend of mine who had a sign company. So we put him in part of the building. I made him a partner on the sponsorship side so that he would be incentivized to move when we needed his space. We rented it to him for $5 a foot. So from day one, I had income coming in. I've only done one conversion where I wasn't getting income from some other use. Even if I was renting it out at $1 a foot for just general warehouse, I had some money coming in while I did my construction and did my lease up. So we got a layout from the fabricator. In phase 1, I think we had 42,000 square feet and about 2/3 of the building, first and second floor. I closed on that building at the end of March. I don't remember the exact date. And we leased our first unit the first week of October. Today, it'd probably take a little longer, but conversions are good because it's a lot easier and it moves faster than expansions or ground up development. Expansions are just a mini ground up development. So, and it's usually all climate control. In my pro forma, I showed $15 a square foot as projected income. By the end of the first 12 months, we were getting $17.84 a foot. That was our rent in that warehouse building. And then we got the first floor. We were 50% leased up on the first floor. I didn't even start construction until I hit that 50% on the first floor. Didn't start construction on second floor, built that up, leased it out. And then we moved the sign company to another building and did their space. And, the cost for the system is less on interior buildings. The I start getting to profitability faster, and and it's usually a climate control. So you're getting whatever the maximum amount that trade area will offer, you're probably getting it or close to it.
Yeah. And you had mentioned kind of at the beginning of our conversation about having, maybe say 25,000 square foot on buying an existing one and then adding another 25 to make it so that it, is institutional. Is that still a formula that works? Are institutions still looking at, say, 50,000 square feet and above, or has that changed over the years?
Great question. It's still a really good model, especially with all the consolidation going on. Most of the REITs today, and there's not that many of them, but most of the REITs today and funds today like having personnel on site. Still, even though there's a lot of managerless office, automated, but you've got to be typically at 50,000 square feet or more to have the economics to make it feasible to hire a manager. So most of them still do it. One of them is now doing smaller 25, 35,000 square foot automated systems where there's no manager. It doesn't mean there's no employees. Somebody's still got to be there cleaning, getting units ready, etc. But it's the move-in process is automated, and all the other operations that a manager typically does are done out of one central office. And today you can even vendor that out if you want to. I'm involved in one project right now that is automated, but I'm probably old school. I still like managers because I like the customer service level involved. And my experience is, and I don't have any hard data on this, but my experience is in our facilities, the gap between economic occupancy and physical occupancy is usually 5% or less, because they're even a well-run facility. There are some people who are late, and you got to do collections, etc. My experience on automated facilities is that gap's not huge, but it's a little bit more.
Yeah, that would make sense.
Yeah.
But maybe, how about your storage world analyzer? Is that the system that you were talking about where you can find the data within that market area?
No, that's a financial analysis software.
Okay.
So the history of that is, so a lot of people, if you're good with Excel, you really don't need it. But a lot of the people, when I got into the training, coaching, I have classes, I have workshops, I do one-on-one consulting some. I limit that, but I still do some of that. But what I found is a lot of the people that are attracted to self-storage are not real good with Excel. So, and even myself has made mistakes. I actually can tell you that I've been in investor presentations and somebody wants to see something. So I pull the computer out, open up the Excel sheet, and dang if I didn't have a mistake in one of the formulas because I'm using the same kind of spreadsheet over and over. So the history of the analyzer is that I was working with this REIT in the mid-90s. And I was using this sophisticated software, Argus. I don't know if you're familiar with it, but it was a powerful program, still is. And that's what REITs in the office and retail business often use is they're analyzing deals. And so I go out with this REIT, like top of the food chain in the storage space. He's got this simple little 2-page kind of Excel sheet. So he gave it to me because this is how they analyze it. So I took his Excel sheet and kind of expanded it out and created 10-year cash flows and, summary pages and IRRs and cash on cash. So I did all the things that I was usually looking at in the Argus software, but I did it in Excel. Now, the main difference is in every other kind of financial analysis software or every other asset class, you always start with the rent roll. That's where your income comes from. You enter the rent roll into the financial. Well, you can't do that with storage. We had one with over 1,000 customers. By the time I got that rent roll entered, it had been changed. It'd be different. So you start in storage with your unit mix, and then you apply a stabilized occupancy rate to it to come up with what your projected income is or what it could be. So I was working with this Excel sheet, and that's what I started working with, and that's what I gave a lot of the people I was supporting to use. And then a lot of mistakes were being made. People didn't know how to do it. And so I hired a coder to create a cloud-based version of what we had on Excel, is basically it. So that's the financial analysis software I use. What I get the data from on the trade areas, I just subscribe to that. Companies like Radius Plus, Yardi, there's probably 5, and they're all good. There's probably 5 or 6 out there that are really good, that are kind of industry standards today.
Okay. And what about the hold period, Mark? What are you typically targeting? And that may be different from project to project, but just in general, if you're looking at a facility, how long are you looking to hold it before you either sell it or, I guess, refinance it? I guess sell it.
Well, our initial business strategy was that we would use investor money, and pretty much you got to get bank loans when you're doing value add plays. There's no life insurance company or CMBS loan that's going to loan to you or very few while you construct and go through the value add play. They want stabilized assets. So we would get bank loans. And what we discovered was our initial plan was we would do the value add play, expand it, build it, lease it, get it stabilized, run it, get a year's worth of stabilized NOI, then refinance it, pay our investors off. They could either stay in the deal or we'd buy them out, and then we keep the assets. That was our initial plan. So for my experience is, given how long it takes to lease and get to stabilization and construction time, it was usually 4 to 5 years. And then the investors could stay in or go depending on what they wanted. What happened in the teens, that was our plan. We started in 2012. By the time we were getting to 2017, 2020, cap rates had really compressed. So I was getting offers, unsolicited offers, when it came time to refinance. Okay, and we did that a lot. We would refinance, cash out, put a CMBS loan on it, and then our game was to just keep it. But we were getting offers at such extraordinary values, didn't make any sense to me, but at such high values that they were well beyond anything, what we had predicted as value by year 10. Because when we were initially underwriting them, we might use a 6 cap or a 7 cap. I was getting offers in some projects in the 4s. It was just crazy. And I realized I would run the math, and I realized for my investors, even if I added another 100,000 or 150,000 to the NOI and cap rates go up 1.5% or 2%, they're still netting more today than they would 5 years from now. So we sold 2 brands I had created, one of a more urban brand and one of a more suburban brand. We sold one to a REIT and one to a fund. And I did it simply because we were maximizing investor returns. So my initial goal was to have a portfolio I would hold for years. And it turned out that it was about a 5 or 7 year hold. Today, there's a lot more syndication going on. Investors are a lot more savvy than they were 10 years ago. And they have a lot more opportunities to look at. So today, we're primarily targeting for a 5-year hold or so. Then, as sponsors, we may buy them out and keep it, or we may sell the asset. We don't know. Some assets we're excited to keep. We want long-term in our portfolio. I would say 70% will probably sell. And it's a 5-year that's the target, 5-year hold. So we're designing IRRs and cash on cash returns around a 5-year hold.
Okay. Makes sense. Well, this has been great, Mark. This has just been just a ton of information, and I just always love hearing about the storage game, and you've done a lot in this industry. How can people find out more about you if they'd like to invest?
Well, good. I have a couple of websites. I have Creating Wealth through selfstorage.com. That's the title of a book I wrote in 2015, and that's the title of my website. And it has a lot of free training and information on storage. And we also have resolveselfstorage.com, which is our construction site. But you can also email me, mark@helmproperties.com, and I'll respond to the emails.
Perfect. And I've got two other questions for you that I ask every guest. One would just be any advice you might give somebody who's listening in and they're just getting started in their investment journey.
Well, I know it's hard to do one single thing. And I know people have said this on your podcast because I've listened to a lot of your podcasts. But I always start, if you're trying to get in self-storage and you have another job and you want to learn about the business, probably the safest way is to invest with somebody, whether it's me or anybody. Invest as a passive investor, learn a little bit, or get a coach or a consultant, someone like myself, or there's a lot of them in this space now who've done it and can kind of guide you through the process. But mostly what I tell people is if I'm coaching with them, I've always started with myself first. I work on myself first. So anytime I expand, when I was going from 2 or 3 facilities and I was real clear I wanted to build a $60 million portfolio, the very first thing I did was, I'm not saying you should do this, but I went to Tony Robbins. I worked on myself first to find out where my thinking could be the ceiling on what was possible in my life. Then I worked on learning about syndications. I worked on learning the trade, but I always start with myself first. And I highly recommend that, whether you're doing storage or whether you're starting a business or whether you're getting married. Work on yourself first, see where you are the limitation on what's possible in your life, then go out and learn about the trade.
No, I think that's great advice, Mark. How about a book recommendation? Doesn't have to be real estate related. It certainly can be. Just something that's been impactful.
Well, I don't want to say the one book that everybody would probably say is Think and Grow Rich, but here's a book I read every morning, and I just kind of recycle it. It's a book called The Science of Getting Rich. It's by Wallace Wattles. It was written in 1910, and it's an old book, but it was, to my knowledge, one of the first books written on how, the mindset and what's involved in creating wealth from a mental perspective. And it's really a kind of put the screwdriver in screw, rotate 3 times kind of book. It's like a how-to. It's very short. And I read a chapter in it every day, and it really has changed my life. And it's one of the ways, not the only way, but one of the ways I start every day with my mindset in a powerful place so I can go out and, play the games I'm playing in life. So if you haven't read that book, read it.
And give me the author's name one more time.
Wallace Wattles. He was actually a New Thought minister. But he wrote the book called The Science of Getting Rich in 1910. He passed in 1911.
Oh, wow.
Like, this was his life's work. I mean, this is one of the reasons he was here in the time span he was to create that book, or at least that's what I've created.
No one's recommended that one yet, so I appreciate it. I'm always looking for new books. That's part of the reason why I ask. So
it's a simple little
check it
read,
out.
but it's changed my life.
Awesome. Well, Mark, this has been fantastic. Thank you so much for being on the Wealth Flow, and I think we'll call it a show.
Well, one thing I like to say before we go,
Yeah.
I really like to acknowledge you, Keith. First of all, I've never seen a quote financial advisor that thinks outside the box like you do. And I've never seen a podcast with such a wide variety of really like sharp people who've created a lot of wealth in a lot of different areas. I think you provide a real service to the world and particularly to the people that listen to your podcast. So I acknowledge you for that.
Thank you so much, Mark. I really appreciate that. All right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.